Gains from trade are improvements in income, production, or satisfaction owing to the exchange of goods or services. International trade is the exchange of goods and services between people or firms in different nations. A tariff is a tax on imports. A quota is a governmental limit on the quantity of a good that may be imported or sold. A commerce clause is the clause in the United States Constitution that prohibits restraint of trade between states. This figure illustrates the rapid expansion of trade worldwide as a result of the decrease in trade restrictions and the decrease in the transportation costs. By 2002, international trade accounted for 24% of GDP. Comparative advantage is a situation in which a person or country can produce one good at a lower opportunity cost than another person or country. Absolute advantage is a situation in which a person or country is more efficient at producing a good in comparison with another person or country. If you recall, opportunity cost is the value of the next best foregone alternative that was not chosen because something else was chosen. This table provides an example of productivity differences of two goods, TV sets and vaccines, between two countries, the United States and Korea. The productivity is measured by the amount of each good that can be produced by a worker per day of work. According to the table, one worker in the United States can produce 6 vials of vaccine per day, or 3 TV sets per day. One worker in Korea can produce 1 vial of vaccine per day and 2 TV sets per day. Note that in both goods, the United States has absolute advantage in the production of both goods, as its workers can produce more vaccine and more TV sets than Korea per worker in one day. Which country has the comparative advantage in the production of vaccines and TV sets? For vaccines, the United States opportunity cost of one vaccine is half a TV set, while the opportunity cost for Korea is 2 TV sets. The United States has a lower opportunity cost and hence the comparative advantage in vaccine production. For TV sets, the United States opportunity cost of one TV set is 2 vaccines, while the opportunity cost for Korea is half a vaccine. Korea has a lower opportunity cost and hence the comparative advantage in TV set production. If the countries choose not to trade with each other, the exchange between vaccines and TV sets will be the opportunity cost of production in each country. A TV in the United States will sell for 2 vaccines, while the TV set in Korea will sell for half vaccines. Similarly, a vaccine in the United States will sell for half a TV set, while the vaccine in Korea will sell for 2 TV sets. If the relative price is going to be the same in both countries, then we know the price must be somewhere between the prices in the two countries before trade. Trade price for one vaccine is between half a TV set to 2 TV sets. The trade price for one TV set is between half a vaccine to 2 vaccines. The calculation of the trade price is summarized in this table. Suppose that there are 10 workers in the United States and 30 workers in Korea. To exploit their comparative advantage, United States workers will produce vaccines only, while Korea will produce TV sets only. Both will trade at a price of 1 vaccine that is equal to 1 TV set. The United States workers will produce vaccines only, a total of 60 vaccines, while the Koreans will produce TV sets only at a total of 60 TV sets. This table illustrates the gains from trade due to comparative advantage for the United States and Korea. By moving US workers out of TV set production and into vaccine production, the maximum United States gain from trading is 30 TV sets, with a trade price of 1 vaccine equal to 1 TV set. Similarly, by moving Korean workers out of vaccine production and into manufacturing TV sets, the maximum gain by Korea from trading is 30 vaccines. The gains from trade due to comparative advantage can also be found graphically with production possibilities curves. The gain from trade is illustrated as a shift out in the production possibilities curve, allowing both countries to consume more TV sets and vaccines if they choose not to trade. What is the principle of comparative advantage? It is by specializing in products by which they have comparative advantage, countries can increase the amount of goods available for consumption. In our example, the opportunity costs in the production of vaccines and TV sets were constant, and the production possibilities curves are linear. As a result, both countries completely specialized in the production of one good only. In the real world, opportunity costs are increasing and the production possibilities curves are bowed out. In this scenario, incomplete specialization occurs and both countries produce both goods. Using our example of vaccines and TV sets, we can identify one scenario in which two countries, the United States and Japan, cannot benefit from specialization in trade. This table illustrates the production differences between the two countries in the production of TV sets and vaccines. In producing vaccines, the United States opportunity cost of one vaccine is half a TV set, while the opportunity cost for Japan is also half a TV set. In producing TV sets, the United States opportunity cost of one TV set is 2 vaccines, while the opportunity cost for Japan is also 2 vaccines. Which country has the comparative advantage in the production of vaccines and TV sets? Neither country has the comparative advantage in the production of either good. If the countries choose not to trade, the price must be somewhere between the prices in the two countries before trade. Trade price for one vaccine will be between half a TV set, the US domestic price, to half a TV set, Japan's domestic price. Trade price for one TV set is going to be between 2 vaccines, the US domestic price, or 2 vaccines, Japan's domestic price. Since the relative trade price between TV sets and vaccines should be between the domestic price of TV sets and vaccines of the two countries, then no trade price will give the countries a mutual gain from trade. There is no incentive for either country to stop trading at home and start trading with the other country. One final note. There will be no gains from trade in this example only if the production costs are constant. In example, there are no economies of scale. We will get back to this later when we discuss gains from trade through expanded markets. One reason why some countries have comparative advantage over other countries is because some countries have a higher amount of the input that are used more intensively in the production of one good. Capital abundant is a higher level of capital per worker in one country relative to another. Labor abundant is a lower level of capital per worker in one country relative to another. Capital intensive is the production that uses a high level of capital per worker. Labor intensive is the production that uses a low level of capital per worker. Factor price equalization is the equalization of the price of labor and the price of capital across countries where they are engaging in free trade. Trade tends to increase the demand for the factor that is relatively abundant in a country and decrease demand for the factor that is relatively scarce. Hence, if a country is selling a labor-intensive good to another country, the wage increases in the country with lots of labor and drops in the country with less labor. Factor price equalization can explain one particular trend in US wages: the rise of wages for the skilled workers over unskilled workers over the last 20 years. The demand for goods and services produced by skilled workers increased over the past 25 years, resulting in an increase in the demand for these workers and an increase in their wages. In the top panel of this figure, it illustrates a situation where two countries, the United States and Germany, have the same technology and can produce the same number of MRI equipment and ultrasound equipment with the given amount of resources. Both countries also produce both goods at the same cost: $300,000 for an MRI machine and $200,000 for an ultrasound scanner. The bottom panel of the figure shows that if the United States produces 2,000 machines instead of 1,000, it can significantly lower the production cost to $150,000 per machine. Similarly, if Germany produces 2,000 ultrasound machines instead of 1,000, it can produce at a cost of only $150,000 per machine, down from $200,000. Intra-industry trade is trade between countries in goods from the same or similar industries. An example, ultrasound machines and MRI machines. Inter-industry trade is trade between countries in goods from different industries. An example, TV sets and vaccines. This figure illustrates the relationship between the number of firms in the market and the cost of producing each unit. Comparing the graph on the left side with that on the right side of the figure, we can see that in a larger market, the cost per unit of producing a good is lower than in a small market. Another observation in the figure is that regardless of the size of the market, the cost per unit declines as the number of firms increases. This figure illustrates the relationship between the number of firms in a market and the cost of production per unit. With the same sized market, a larger number of firms will result in a higher cost per unit. However, as the market size becomes larger, the curve shifts down, representing lower cost per unit with the larger market. As the number of firms in the market increases, the market becomes more competitive, and the price that each firm charges for the good decreases and moves toward the cost of production. This figure illustrates the relationship between the price and the number of firms. This figure illustrates the long-run equilibrium number of firms and cost per unit in the market. The equilibrium is determined by the intersection between the cost per unit curve and the price in the market curve. This figure illustrates the gains from trade due to a larger market. When trade occurs, the market increases from the size of the market in one country to the combined size of the markets in two or more countries. This larger market shifts the upward sloping line down because cost per unit for each firm is lower when the market is bigger. This brings about a new intersection and a long-run equilibrium at a lower price.